Thank you so much,
You're an
Sanjeev.
amazing human being and an amazing stock picker.
Always a
Because
total
I think,
pleasure and delight.
concept. Yeah, hi. Welcome to the 20th episode of FINtastic Talks. And let me thank all the audience which has been giving us a lot of love and affection and the motivation to keep going. Because without you, we wouldn't have been able to do the 20 episodes, and we won't be planning many more and many more exciting episodes to come. It is only the love and affection that all of you are giving and the kind of audience that we are getting. Last time we had 7,000 live viewers. Most of our programs are now being watched between 20 to 50,000 views in the next month or a couple of months, so which is amazing. And I would request everyone who's there to help us popularize it, because that makes the time worth it for me, you, and every star speaker that we are bringing here, and who's here to add value to you. And these guys have amazing knowledge and skills and experience. And if you listen to them, you read between the lines and you implement, try to make some implementation point from every talk, it's going to be amazing for you. My own principle, the purpose I am doing this talk is helping you generate a second income. And as I always explain, and this is something I'll keep doing, that second income means that there needs to be if Sanjiv Bajaj is a person, then Sanjiv Bajaj's investments need to be a second person. And you need to manage that second person like a business. You have to make sure it is giving you a good return. And one day, the second income is equal to or more than your current income. And if you are able to reach that, then you are able to reach the financial freedom. A lot of people talk about financial freedom, but they don't know how to reach that. So this is important. For those of you who are new to this journey, we have this program called FINtastic program. Please check it out. It's called Be FINtastic. Go do the program. It's 15,000 rupees, 3 weeks. If you don't like it, we give 100% refund of money. But if you know how to invest and how to create wealth, nothing in life will be able to stop you. And our purpose here is not to make money, but just to have serious people who are willing to make that contribution and start. And that's why we keep 100% refund thing. If you're not happy, just take your money back. There'll be no questions asked. So please do look at that. And for those people who are professionals from our industry, as I always say, please be better, please be more professional, because this whole industry depends on the quality of advice. So do your certified financial planner from ICFP or any other great institution, and be very good on that. Now, without further ado, I'm very excited to have one of the superstars of mutual fund industry with us today, Navneet. He's been a part of this industry for 27 years. He himself is a CFA charter holder, a chartered accountant, and an amazing human being. And I don't want to say too much, and I will let him do his own introduction. But he's one of his super achievements was that he joined SBI at a 20,000 crores, and when he left SBI, it was probably one of the largest. It was the largest asset manager in the country, and that was an amazing achievement, going in and bringing that change in culture, aggression, and that has remained. So Navneet, without further ado, welcome. Thank you for taking out time and being here for this talk today.
Thank you so much, Sanjeev. It's always a pleasure to talk to you and Rajiv, all good friends, and so many of my good friends at Bajaj Capital. I've been an admirer of your founder, Mr. KK Bajaj. I think he's a legend. He was far ahead of his time, starting a financial planning and distribution business in 1960s, 64 or 65, if I remember correctly.
Yeah,
And that speaks volumes of his vision. And I commend the way you all have built the franchise, and it's a big household name across the country. So kudos to you guys.
Thank you, Navneet. And some of the things, I don't know whether you know it or not, SIP was actually conceived by him. So
Yeah.
this systematic investment planning, that time they used to sell shares of companies like Ponds, Lakme, and the companies that used to be very good, Hindustan Lever, Unilever, and they used to sell a share a day or a share a month and a share a week, and the whole concept of SIP, make your children lakpati. So it's been a long time, but going by his own saving, he
Yeah.
saying he says that you don't become old, you become outdated. So that is something that we have lived by, and we have to keep ourselves updated, because if you're not playing in the match today, then you're out of the match. So you have to be on
Absolutely.
updated. You have to be on it anytime. So
Absolutely.
Navneet, great to have you with us today. Before I get into the investment markets, and I know there'll be a lot of people out there. There's a lot happening, with the IPO boom, the crazy pricing. There's a lot of concern, growth versus value. So we'll get into all that. But before that, I want to understand Navneet as a person. So just tell us about yourself, your journey, your childhood, and your parents. So it'll be great to know for us to hear about that.
Sure. So, Sanjiv, I come from a small town in Rajasthan. There's a place called Byawar. It's in Ajmer district. Ajmer, you might have heard of. And I was lucky to be part of a family where I think my father inculcated the habit of like having a curiosity, reading as much as you can. Of course, in a small town in 70s and 80s, you can imagine the sources, but still, I think we were very, very lucky. I ended up doing my graduation, post graduation, and a chartered accountancy from that town. And luck had it, I got 50th rank. In fact, had I got 1 mark less, I wouldn't have got the rank, and life would have taken a different turn altogether. So it just shows the role of luck in life, and we should never forget that. And the first time, the first place that I joined was a company called Birla Growth Fund Limited. This was the holding company of the financial services business of Aditya Birla Group. I spent like 14 years in the group across all spheres of financial services in the finance company, mutual fund, insurance, investment banking, securities. I think so. Worked in all spheres, but a large part of that was in Birla Mutual Fund. CIO for fixed income and hybrid funds. Worked with outstanding people. Learned so much in those 14 years, and still I have so many friends among them, and they will always remain my guide and mentors. Briefly, I was in Morgan Stanley as head of multi-strategy boutique, and then moved to SBI Mutual Fund between 2008 and 21, little over 12 years. We had a great bunch of people driven by a passion and saw a great success. You talked about it earlier, but I would say it was a great team and a great brand. Everyone in financial services in India has an aspiration to be associated with SDFC Group. And I was so fortunate to get this opportunity. It's indeed, I would say, an honor and a privilege to serve SDFC Mutual Fund. We have the same ethos and values as SDFC Group. And as you know, the group is synonymous with trust and confidence. And we have the same ethos, same values as the parent. So it's been, 27, 28 years in financial services. It's been a great journey and absolutely a dream journey.
That's very interesting, Navneet. One thing I didn't realize, and that this fantastic talks has taught me, that most of our mutual fund CEOs and leaders are coming in from a smaller towns, and I think that's a great inspiration to people. And most of the people I've talked to, whether it is Bala from Aditya Mutual Fund, sorry, Birla
He's a
Mutual
great
Fund.
friend. We used to sit next to each other in the dealing room, and we
Yeah, so
spend good time together. A great
he
friend.
was also sharing with me how he's from a small South Indian town, and so many others. I can take, and it's such an inspirational story that there are so many people today. India is not just Delhi, Bombay, Bangalore. India internet has united India, and I think
Absolutely.
unified India, and it is your education which is the key to get out of that. Education is a key which can take you from any time to anywhere. I also do a similar talk with entrepreneurs, which we don't publish. But there also it's so amazing to see how people are from even the smallest part of the country today are coming in, rising up, being such amazing entrepreneurs that it is so exciting to see that. So just tell us a little bit about the small town life of yours, and what were your dreams and aspirations at that time, and some inspirational words from others, because we have so many people from B, C, D, E category town watching this program, that how do they achieve their dream of being a CEO of if you're a CEO of an HDFC company, which is like one of the ultimate goals for any financial services professional. So how do they start from a small town and how do they reach here? So just tell us a little bit about your small town life and how it, how it shaped you.
No, of course, I mean, come from a middle class family. In fact, I keep thinking whether the middle class is the right word. I think the right word should be middle income with high values. And one of those values was like, I mean, what is the value that we can add to others? And I think having a deep sense of purpose was, I think, probably I was so lucky to be part of a family where that was like one of the key values that got inculcated in us. My father always used to say, I mean, read more, meet more, and we were always successful in the long run. So have that deep sense of curiosity, keep learning, and wherever you are, I think it's an important to have that sense of curiosity, have that sense of hunger, have that sense of a deep perseverance. I think one of the things, as you talked about, maybe in smaller towns, that maybe for small things, we need to maybe run around a little more. And I remember when I was doing pursuing my chartered accountancy from there, and there was no coaching there available, right? So you have to go through the entire thing on your own. And if anything that remained unanswered, it still remain unanswered even now, because I think there was hardly any formal coaching. And of course, those were the days without the internet and all. And I remember the Economic Times used to come on the third day, second or third day used to get delivered, and we used to read prices of, like, let's say on Wednesday and Thursday, what the prices that got traded on the day of Monday. There used to be, I remember, was it All India Radio or where, at 6:05 or sometime in evening, they also used to give the stock prices on a daily basis. So right from A, like Mara Sarabhai, to Z, Zenith something, Zenith Steel or something. So some 30 or 40 or 50 stocks they used to give the prices, and we used to kind of write those prices in those days. So it was like a great time, and but of course learned a lot. And I think some of those values that got inculcated have helped me through the life. Yeah.
Superb. Now coming to our, question that we are trying to solve today, Navneet, what do you feel about the markets here? Where do we stand? And, what are your views about the market? What are your views about India in the next 10 years? And how would you advise the investors who are here, who are looking to start their journey, or who may even have invested? How do you advise them? What should they be doing?
So I think a few months back we wrote a note on, like, talking about 6 or 7 R. Just try to create this acronym that one should keep in mind while we were in the second wave. There was, of course, a huge human toll, and we were all worried about what was happening. But at the same time, I felt very positive about the longer term direction and the growth. And that was based on that optimism came from the global reflation, a strong view that we are going to see a new wave of growth in the global economy, driven by very accommodative monetary policy, very accommodative fiscal policy. I mean, the governments world over responded rightly to this crisis by spending more money. A lot of growth enhancing policies. If you look at US, I think their commitment on spending money on infrastructure and a couple of other things. And also the fourth thing was the innovation and COVID has accelerated a lot of innovation in the world. So because of some of these factors, there would be a new reflationary cycle. India would be a big beneficiary of that global reflationary cycle. There would be ups and downs. Of course, there was a lot of pent-up demand. As that demand at some point in time, that pent-up demand may not be there. But structurally, over the next couple of years, due to these factors, I believe we are going to have a good global growth cycle. The other R, if I remember, was like the RBI's very bold policies towards supporting growth. Over the last 15 or 18 months, they've done a phenomenal job in terms of ensuring financial stability, macro stability, and of course, supporting the large government borrowing program and ensuring that growth remains the primary focus given the overall situation. Other were the reforms that, despite the pandemic and all the challenges that we had, I think government didn't take the pedal off. The reforms accelerator. They continued with many more reforms, particularly in the area of farm reforms, labor reforms, PLI, so on and so forth. I think the other, if I remember correctly, was realigned geopolitics. There is so much of animosity towards China, and India would be a beneficiary of that structurally, I think, and with the policies that we have pursued on PLI, etc., with China plus one policies of a lot of global businesses, I'm sure India would be a beneficiary of this whole supply chain realignment. The other was the redesigned world, particularly from a digital and virtual angle, that the world is getting a lot more digital. And I think India has done a great job on the digital economy side, on the digital innovation side. You are seeing the number of unicorns have got born, or the way government has used it for delivering a last mile for the last mile delivery, or for better governance, or the way businesses have adopted the whole new digital world, and I think it will keep us in good stead. I think the another R was, if I remember, was the real estate cycle. I think we are going to see a new a real estate cycle. I think it's been like I would say a tough time for last several years, but for a variety of reasons, and we can discuss that particularly on the residential side, the genuine demand is likely to come back, and we are going to see a new cycle at lower prices, lower mortgage rates, so on and so forth. And with all of this, we are going to see a new investment cycle. And when investment cycle kicks in, that time you have job creation, you have income growth, and when jobs get created, people's income rise, and they also save, they spend money, and you get into a virtuous cycle. So I think all of this over the next several years, I think India seems to be on a good wicket. I think I used one of the R was the revenge consumption. That time, a lot of people were saying, I mean, look at what's happening in the economy, and we were in that second wave. And my view was that there's going to be a pent-up demand, but also that despite the psychological scars that have got in our mind because of the second wave, but I think human beings are, I mean, in our DNA, we are supposed to be socially interacting people and not socially distancing. We are not made for that. So I think as and when things open up, there is going to be like a lot of activity. Travel will boom. I think overall consumption will come back. Of course, there are some supply side issues. Everything is in a shortage, which will get addressed. Again, there would be some bit of this pent-up demand which will go down. But structurally, if you ask me next several years, I think it looks good. And with all of this, the last but not the least, if I remember correctly, I wrote the resilience and the resurgence of corporate India, that corporate India has shown a huge resilience given the challenges during this period and has innovated more. And I think now we are going to see a new profit cycle. And with this new profit cycle, I think it's the earnings growth that will drive the market return. Markets have re-rated quite a bit, particularly driven, I mean, thanks to also driven by lower interest rate and the amount of liquidity which has got printed by global central banks and RBI as well. So of course, I mean, there could be a bit of consolidation, but structurally, if you ask me next several years, very positive on the overall growth cycle. There could be in the near term, I mean, it's almost impossible for anyone to predict the market. But I think, yeah, structurally, it seems that I think, yeah, India is on a good wicket.
Very well answered, Navneet. I think your point is absolutely right, that India is on a very strong wicket. And, there is a lot of wealth creation that is going to happen over the next decade. And the right question is that how do people be a part of this wealth creation? So I will, my next question I'll pick up from something one of the clients, one of the our audience has commented. There's a lady called Anushka, and I see her very regularly in the talks, and she's also very active with the comments. So she was saying that Sandeep has Sikka had advised on balance advantage funds, which has done well for her. Although Anushka, I like to say this is from Nimesh Bhai. So this is Nimesh's favorite statement that whenever you are confused, go into balance funds. So and there are others, who have their philosophy of going in for value at this time when growth stocks are very highly valued. So Navneet, what do you recommend? Like for a layman investor, he wants to enter this market. What is your advice at the moment? What type of fund should he choose? One, if he wants a debt equity mix, or if he just wants to be an equity, what would be your advice that where should he be coming in?
No, sure. So on the debt side, of course, I think if the depending on your goals, your return expectations, on your risk appetite, the time horizon, when and liquidity preferences, etc., you need to do the right asset allocation and then choose the right fund to allocate your money. But if you're asking that, I think and the rate cycle has bottomed. Policy rates are likely to go up over the next few years. Having said that, the yield curve is very steep. When I say yield curve is very steep in simple terms, the short-term rates are very low, but the long-term rates in this cycle have not fallen so much. So maybe I think in a short-term fund or a medium-term fund, you can put money from a debt perspective. If you have a little bit of risk appetite, then hybrid debt funds, which invest in equity up to 25%, that could also be another option to look at. One can look at several other solution products because you specifically asked about the balance advantage fund. In fact, we are one of the oldest balance advantage fund in the country. Over 25 years, it's been a great wealth creator for lots of people over the years. I think the kind of return that it has delivered over a very, very long period of time, that option can be looked at. One can also, you talked about the equity fund. So maybe at this point in time, we don't have a strong view on a large cap versus mid cap versus small cap, but maybe a multi-cap fund where the fund manager invests in all three categories up to, at least 25% in large cap, 25% in mid cap, and 25% in small cap. The remaining 25% can be in any market cap. I think that could also be an interesting option.
That's superb. And again, another question by Anushka only that she's asking about Paytm and Nykaa IPO. Now, what is your view on these? This is, I know, a controversial question that about the valuations of Nykaa, Paytm. Do you think there is going to be this is like a dot-com bubble, or is it, what is happening out there?
So how do I put it? So maybe I think first of all, the question that companies not making too much of money, but the valuations. I think Amazon wasn't making money when it got listed, but turned out to be one of the largest company today, more than $2 trillion of market cap. But am I justifying investing in any company that makes a loss or doesn't make too much of revenue and still command a huge valuation? Not really. There was one Amazon and few others where investors made money despite the fact that those companies weren't making profits at the time of listing. But I would highlight one point. For every Amazon, there were many companies in that era that didn't even survive. So one has to be very, very cautious in investing. I remember this quote. I think sales is vanity, profit is sanity, and cash is reality. Ultimately, a business has to justify its existence through delivering adequate return on the capital. But you cannot generalize, and I won't comment on particular name. But I think there are times in markets where certain excesses happen. I'm not talking about any of the stocks or any of the IPO or any of the segment of the market. But that you always have this period where a certain thing catches quite a bit of fancy in the market. But I think one needs to remain focused on the long term. One needs to remain focused on the basics of investing. The fundamental tenets of investing never change.
Very well answered, Navneet. Also, there's a question by Rishi. He's asking that has the tapering started come in Indian markets have been moving sideways. Is it something that we are going to expect to see in the long run?
So I think the central banks, particularly globally, since 2008, have been pursuing extraordinarily accommodative monetary policies. Every time there was a crisis or there was a challenge in the economy or in the financial sector, the response has been simple and straightforward: cut interest rates, release more liquidity into the system, buy assets, and various ways. I mean, very, very creative and bold ways. Different central banks have reacted to every crisis over the last several years. A point has come where I think the balance sheets of central banks have become very big. Interest rates, I mean, not in India, but in large part of the world, is like the policy rates are close to zero, or the short-term rates in several parts are below zero. Can this continue forever? Unlikely. At some point in time, when growth comes back, when inflation comes back, central banks will have to take the punch bowl away. They will have to take some bit of this liquidity out of the market. Whether the process has started, we have seen some of the emerging markets have already raised interest rates in last few months. And as of now, I mean, if you look at the markets are expecting some of the other central banks to increase interest rates from next year onwards. I think that normalization of monetary policy is very much likely to happen. And particularly in the stock market, or let's say any other asset class, a part which has benefited the most from this easy liquidity or the low interest rates is the part of the market which will get more impacted. So wherever profits are more back-ended because you are discounting them at a lower rate, I think those sectors or those stocks or those segments have benefited the most. I think they will get impacted relatively more. Wherever the profits and cash flows are more front-ended, they will be impacted less as and when rates go up, as and when liquidity shrinks. And there are like several areas. I mean, you look at what's happening in the crypto world, you look at the NFTs, you look at the SPACs, you look at variety of things. Whenever there is so much of liquidity chasing few assets, you get some of the excesses in different pockets. I think that's the part of the world, I mean, that one needs to be cautious about. I mean, but as famously said by, I think, Keynes, that markets may remain irrational for longer than you can remain solvent. So it's very difficult to pinpoint at what point some of these things will get impacted. But I think one needs to exercise caution.
Yeah, and US markets are a good example of that. The people have been expecting that correction for the last decade, where they said things are overvalued. And let me say, it's my passion to do startup investing. And the way startups have done, I have made a lot of money in there. But at the end of the day, you don't. The valuation is something even I don't understand. So but it's an exciting place. Money is coming in, and these businesses are built by money only. So if there is enough money backing the startups, then I can't see how they will not grow.
So it's like beauty, it's in the eyes of beholder.
Yeah, beauty
Different
lies
people
in
look
the
at it
eye.
differently. Yeah. But I think the amount of liquidity which has got unleashed in particular last few quarters post the COVID, and even before the COVID over the last several years, I think that has made an impact in terms of valuations where they are now, because ultimately the discounting rate decides also, I mean, is one of the important factor in valuation. And when the discounting rate is lower, obviously it inflates the valuations of various asset classes. Yeah.
Yeah, Navneet, there is a lot of questions on the US liquidity. There's a lot of figures going around that before the currency in circulation in US was $3 to $3.5 trillion or what, and right now it is at $7.5 to $8 trillion, and plus there is more being printed, and this buyback of the junk bonds that was done by the Federal Reserve. What exactly was it? Because a lot of our viewers asked this question. They've heard about this. but they want to hear it from a technical person like you to understand what exactly happened and what brought about this liquidity boom that we are seeing in the market.
So I said that over the last maybe a decade or two, the central banks have been very bold and very creative across the world in terms of supporting the economy, in terms of supporting the financial system. And every time there was a crisis in any part of the world, central banks came and the solution was like this: cut interest rates, print money, release more liquidity into the system, buy assets, and ensure that it doesn't create any problem at the systemic level. Now it has reached a level where different central banks have pursued different things. I think you would have heard about that famous LTRO in Europe, the kind of bonds that they bought. In US, they have bought all kinds of bonds, securitized paper, etc. in 2008, and then in the recent crisis as well. In Japan, I mean, the Bank of Japan has been buying ETFs, even the equity ETFs. The Swiss National Bank has been an equity buyer. So various central banks, I mean, and this is a new world that we have seen, particularly post 2008, where the central bank balance sheet has expanded very significantly and newer kinds of assets. Earlier, it used to be primarily the treasury bonds or the government bonds, which used to find its way into the central bank balance sheet. But now it's looking quite different in different parts of the world. Maybe as we discussed earlier, at some point in time, growth will come back, and this time the growth may come back with inflation, and then maybe there would be at some point in time there would be a tapering where some bit of this liquidity will have to be taken back before it starts creating some other set of problem. Maybe we have lived in a world in last 10-15 years or maybe longer actually, and in fact, the inflation in US particularly or in the Western world peaked in early 80s, and over the last 40 years, it's been a phenomenal bull market in bonds. The 10-year US Treasury used to trade at like almost, I remember, peak at 15-16% or so in early 80s, and then fell to like 1% or so or below that as well. So it's been a great long 40-year bull market. Maybe I think we are nearing the end of it, and from here on, my sense is that I think the inflation is coming back, and maybe this bull market in bonds, I'm not talking about the developed world, is coming to an end.
And so next one, Navneet, is also a very interesting question, and you like it, but it's also a very structural question. So there's one of our regular viewers, again, Madhusudan, whose name I recognize. He's always very prompt in asking the questions. He's asking, should we as investors move along with a CIO or a fund manager when they shift from AMC, like Navneet moved from SBI to HDFC? How do we investors make such moves, and will fund performance get hit? So he's obviously your fan, Navneet. So this is, but overall it's a very important question, that when is it time for a investor to move out of a particular scheme into a new scheme, or move out of one AMC into another AMC? When is the right time? How do the investors take this call? I'll just simply add, please come to advisors like Bajaj Capital. We have research teams who do that, but I'll let Navneet answer that question.
No, absolutely. So when you invest, you look at the pedigree of the institution, you look at the people, you look at the processes, you look at the risk management, you look at the history and all of that. And I don't think that, of course, people are important. At the end of the day, committees don't make decisions for the people, but I think the people and processes and of course the pedigree of the institution, they are all important. And I think you should take that call based on the institutions rather than the individuals. Yeah.
Yeah, but I think, guys, it is also important the philosophy, the way people are doing the fund management, because that is also seeing a phenomenal change. Globally, there are a lot of companies who have brought a lot of analytics into their investing, and same has been done by a lot of AMCs. And today, a lot of these models are very mature. Like I have personally seen some of the AI based models on analysis, and they are fantastic. So there things are changing. You also need to keep looking at the fund management styles, what is happening, what is not happening. I'm not too bullish on the indexes, although indexes have been doing well. because indexes are slave to results. There is a huge saying that whether you should try to predict what is going to win or you just follow the results. And index is a follower of result. If company has grown, even if the valuation is deserved, not deserved, if it reaches an X amount of market cap and a free float, it will come into the index, and then it will get more funds because the companies are investing into the index. So again, there is this lot of debate, Navneet, on active versus passive. And this is also leading to another thing, that what is your view? I know you guys are playing both ways because you are very, very good in active and you've launched a lot of passive funds also. So Navneet, what is your view on that, and how do we, as an investor, what would you tell them?
I mean, in fact, interestingly, we are also, I mean, while we have a long history of one of the best track record when it comes to the active management, I think we have long history of alpha generation across several products over a very, very long period. Our FlexiCap fund NAV crossed 1,000 rupees. So the money has got multiplied 100 times. Sensex may have multiplied probably 15 or 15 times or so, maybe in the same period. So, but at the same time, we are also one of the oldest player in passive. The first product was launched in 2003 because you want to be a one-stop shop. If any investor of Bajaj Capital is looking for a solution and you think the solution would include some active fund and maybe some passive fund, we should have the product for that. Interestingly, there are large number of demat accounts are getting opened, and the ETFs can also be kind of offered to those investors who are active on the secondary market side. Passive products have the simplicity; they are convenient, liquid, cost efficient, just track the market, as you rightly said. But I think, as I said, that we have been a pioneer in active funds and will always maintain our focus on that. Interestingly, I mean, passive cannot exist without active, right? The price is decided by the active guys. Passive just kind of follow that price or just ride on that. But the active managers will never be out of the market. In fact, the passive, I mean, the growth of passive will also lead to maybe an alpha opportunity, because at times, I mean, there would be some excesses that will get created by the way index get created, etc. So I think I'm pretty positive on the future of active funds as well. I think in India the debate should not be active versus passive. It should be active and passive, and both of them are likely to grow. There's a lot of opportunity for alpha generation. I remember a year back or so when people were saying, look at your funds, last couple of years, they haven't generated alpha. But I mean, there are two ways to look at it. One, that we have a long history of alpha generation. And just when people started questioning that ability and whether there is alpha to be generated in India, I look at the alpha generation in last 1 year. I mean, point to point, last 12, 14, 15 months, there's been phenomenal alpha in several of the categories that have got generated by the fund managers. So I think one should not take this debate to active versus passive, but should take this, active versus passive. This should be more of active and passive. Both will have their own space in different investors' portfolios. And I think one should leave it to people like you. I mean, you do the right allocation and allocate money.
So also there's a interesting question by Sachin, which is that should we move 5-10% of our investments into conservative funds? So Sachin, I don't know, what do you mean by conservative funds, because that can have a huge this thing. But Navneet, taking the conversation, like what is your view with the foreign institutional investors being net sellers and they are booking profits? Indian markets are actually being propped by the Indian retail investors, which is a unique situation. Now, when these guys come back, where will this money flow in? There is a huge question whether they will go back into growth stocks or it's time to be investing in value stocks. And I'll personally share my view. Like, I am actually going to be moving 30-40% of my portfolio into value, because I think growth stocks, are at a quite extreme valuation. And I think once the foreign institutional investors come back next year, it's going to be the high value, high quality companies. Obviously, you have to be very selective there. So that's my personal view. That's what I'm planning to do. What is your view on this?
So first of all, in this whole value versus growth, on a very lighter note, I mean, comparing with, let's say, investing and swimming, you never say I do wet swimming. I mean, if you are swimming, then you get wet. So like if you are investing, then you look for value, right? I mean, what is value? You're paying lower than what the intrinsic value of that business or that asset is. And but the way in the sense that these words get used,
Yeah.
value versus growth, is where you're paying quite a bit for the growth of a business, while maybe some of the value investors look at things a little differently, or different kinds of businesses. I think what happened for an extended period, this time the cycle got a little lower, a little longer than the previous cycles of this whole growth versus value, that you had a lot of money chasing lesser number of opportunities. We were in a world where the growth was scarce, but the money was ample, and it was chasing fewer opportunities. And this trend got accentuated simply because there was so much of money also going into passives. In passives, what happens that the market cap goes up, and then the weight in the index goes up, and the more money is chasing the same stock. So the weights of those growth companies where there is a growth, I mean, in the index is an inherent growth bias and a momentum bias, so more money chases that. And on top of that, a lot of this money move, and I'm talking of globally, money move from non-ESG to ESG, and in ESG, particularly the consumer and technology, those stocks at a higher weight versus industrials, utilities, some of the other in materials, etc. So they had a higher weight. So that also got even more accentuated. On top of that, all the algo trading, program trading, etc., which are basically momentum chasing strategies. So we saw a period where the so-called growth and quality did extraordinarily well. But as growth becomes more broad-based, then the rally is also becoming a lot more broad-based, and that's clearly, I mean, as I mentioned earlier, if you look at the alpha in our funds over the last 12, 15 months is phenomenal, because you had a situation in 2018, 19, 20, where the top 5, 7, 10 stocks were accounting for almost the entire returns of Nifty. I mean, if you take Nifty or any other large cap index, versus now as it's becoming more broad based, obviously the fund managers like ours have been doing far better. And I think our worldview is what I talked about earlier: the global inflation, the return of investment cycle, the return of the corporate, a new corporate profit cycle. All of that augur well for that style of investing, which has been out of favor for long, yeah, for some time at least.
So, Navneet, let me pick up a very different question. Then this is a question generally I don't pick up. But given what the way Sachin has again put this question, that what are your views on crypto? Now, with every second advertisement now being of crypto, what to do? And and actually, I think this is something which is creating a dramatic change in the way we're going to see India. Because if the kind of advertising, the kind of accounts they are opening, I was reading somewhere that crypto providers have opened more than 10 lakh accounts have been opened.
No,
So
I think it's more than 10. I mean, if I remember the advertisement, it's more than 10 million, I think. Yeah.
sorry,
Yeah, I
10
think
million.
it's, yeah, few
Yeah,
million.
so
Yeah.
again, if you're talking about 1 crore accounts being open, 1 crore people putting in money in a product that I don't want to comment for you, but at least I don't understand. And although theoretically it's an amazing product, but how practically it's going to work is it's very, very difficult to fathom. What is your view? And with so many Indians investing in it, what do you feel about that?
So I'm not an expert on the cryptocurrency, and won't dare to give an opinion on that, which way they are heading. There are both the camps in the world, and there is a camp which has been very positive on that. There are a large number of people who are very skeptic about what's happening in that world, the way prices are going up. Some people are comparing with the tulip mania. If you have read about it in Holland a couple of centuries back, where a bulb of tulip was valued more than a house. And yeah, I mean, there are a large number of investors, particularly the youngsters, who got a fancy for that. I'm I think the underlying technology, of course, the blockchain has a lot of promise. There are a lot of things that can be done better, more efficiently by using the blockchain technology. I think cryptocurrency is just one of the manifestation of that. But I think the jury is still out. I think we'll have to only time will tell whether it's and the what we are seeing is the wisdom of the crowd or it's mania of the mob. I think only time will tell. I the more I mean, I think that how will a sovereign state uh, keep seeing a trend where a currency and if it becomes a store of value and medium of exchange, I think some of the functions that a currency provides uh, goes out of the hand of a sovereign state, then what happens to the future of the sovereign state? They derive their power from an ability to have a currency of theirs or the power to print the currency. If it moves to in different hands, then what happens to that? So I think there are longer term implications of this. I think different countries are reacting in different or responding in different manner. I'm told, I think last few days you would have heard, I think the government and regulators are also mulling over it. And I'm sure over a period of time it will evolve. And as I said, I think only time will tell whether it's wisdom of the crowd or it's mania of the mob. I think books will be written few years later.
Yeah, I fully agree. And also understand, guys, crypto technically is not an investment because you are in buying a currency. So it's like a wallet. So it's a wallet where you're buying a currency. Now currency is getting overvalued or devalued against any other currency. So you have to understand crypto to a certain level. Calling crypto an investment is a misnomer. It's like keeping a currency. So whether you keep dollars, you keep bitcoins, it's keeping a currency. But as Navneet said, there are so many other implications which are there around this. So you guys have to be slightly, careful
An
there.
investment is where there is an underlying asset, and underlying asset generates income over a period of time. So, but anything else where your investment is completely, I mean, what is the difference between investments and speculation? I mean, here, if it is completely dependent on what somebody else will pay to you for that, then I'm not very sure whether it classifies as an investment, right? I mean, there is no underlying income from this. Yeah, I mean, gold is a little different, and this is a different asset class, but these are early days for this asset class.
Yeah, that's true. So, next question, Navneet, let's pick up a couple of questions from our senior clients. So there's Mr. Iyer Ganpati who's asking these questions. What are an attractive funds for a senior citizen whereby they can get attractive returns in the short period? So, senior citizens who maybe have 1 to 3 years type of a horizon or 1 to 5 years type of horizon. Navneet, what would you recommend to them and why?
So, for one thing, I'll say that the definition of senior citizen one needs to run over simply because I think the lives are getting longer and longer. I think the life expectancy has been increasing, and a person in 60s and 70s highly likely that they are going to be there for several decades and not for few years. The way life expectancy has been increasing, and the second part one needs to keep in mind is the lifestyle inflation that I think you want to maintain your lifestyle or probably the things that one hadn't consumed earlier, but you start consuming things. I mean, think about the amount of money we are spending on electronics, which wasn't the case till some time back. So there is inflation and there is a lifestyle inflation as well. One needs to keep in mind, and accordingly, one needs to save. Having said that, somebody who's conservative, somebody who's a very short horizon, I think should stick to maybe a fixed income fund like a short-term fund, a corporate bond fund, a banking and PSU debt fund. But I think if you have a little bit of risk appetite and can take some bit of equity risk, then maybe one way to start that it could be with a hybrid debt fund where up to 25% goes in equity, the remaining 75% is in good quality fixed income instruments.
Yeah. So Navneet, again, next question on very similar scale, and which is like asking for more elaboration on what you just said. Mr. Prasad GS is asking this question that can I invest my retirement corpus in a conservative hybrid debt fund at this juncture where the interest rates have bottomed out? What will be the impact of these if funds if on what will be the impact on NAV if RBI increases the repo rate?
So I said two things you need to keep in mind. One is that likely that policy rates have bottomed and they go up. But if you say in this part of the cycle, in 2003-4, I think when interest rates were very low, 10-year bond was at 5%. In 2009, I remember, I think it bottomed at even lower than 5%. In January 2009, 10-year bond yield was lower than 5%. This time we are higher than 6%, despite the fact that we had a recession and we didn't have this kind of recession in those years. So this time the yield curve is very steep, and I explained it before. When we say yield curve is very steep, meaning the short-term rates have fallen quite a bit, while longer-term rates have not fallen as much. They didn't decline as much, and there is some bit of that cushion available that when RBI starts raising the policy rates, of course, maybe all the rates will go up, but I think we're already getting compensated to some extent for that. So remaining too much at the front end of the curve or remaining extremely liquid, you are paying some price because the yield of the portfolio currently is lower. I think in the products that you talked about, even the fund managers take those calls. If they think that rates are going to go up, if they think that bond yields are going to go up and then bond prices will fall, they will reduce the duration, which means the impact of rise in interest rates will not be as high as if you have a much longer maturity paper. So they are also dynamically changing that part of the portfolio. And if you are investing for 3-5 years, hopefully the fund should deliver well in line with the overall returns in both fixed income as well as the equity market.
So I think very well answered. I truly believe that hybrid funds today have a place in everybody's portfolio. And I also believe in it. This look, whenever you're confused about the market, just go in for a balance advantage type of a fund, where the fund manager is moving between debt and equity for you. And today, equity Indian scenario is very, very attractive for the next 5-10 years. Plus, also debt markets have seen a lot of turmoil up and down. So I think hybrid debt funds like balance advantages and others become an ideal choice. So even as senior citizens, you need to understand the risk, and if you can afford that risk, then you should look at these funds as a part of your portfolio. It is very, very important. So now
And then there
moving.
are goal-based funds. Like if the goal is to save for retirements, then we have like different plans. I mean, if you are starting at the accumulation stage, and then you can have higher equity allocation, you can have if you have a moderate risk at a later stage, or maybe a later when you are more in the spending and not in accumulation stage. At that point in time, you can have a more conservative portion of the conservative part of the retirement fund. So if you're saving, I mean, retirement is the goal, then you have those products available. A lot of people, for example, I think saving for their children's education or saving when they to meet the goals related to the spending they would have on their kids. I think then you have those children gift fund.
Yeah.
So then you don't have to take specific calls over the years in terms of switching from one asset class to another.
Yeah. I think very well answered by Navneet, guys. Please do follow this advice. Next one question is on financial planning. It's not on investing. Generally, I wouldn't have picked it up, but I want to answer this question because I've seen a lot of people give views which I don't agree with. So this is Navneet. This is a question on by Parmesh Bhojanji. So he's asking a question whether we should go versus EMI versus investment. Now, this is a question I've heard now some experts saying don't buy a house and put everything into investments. You should only do SIPs and rent. Guys, I'll let Navneet answer. But my view is slightly different. Okay, you need to invest, and invest diversification is important, and real estate is also an asset class. So it's not that you put all your money in one basket. If equity has been doing well, don't throw all your money into one basket. And everybody needs at least one abode to live. So when you talk about your own house, which you're going to live in today, which you're going to live in tomorrow, then it is a very good thing to at least buy one residential property per person. Okay, so you may decide not to live in it today because you want to live in a much more better, swankier place where the rent is only 1-2% of the value. Then please take a rental property, live. But you must have a property where you are paying the EMI, where after 15-20 years, that can be your abode which you and your children can live. And it is important. And these two products are not replacement for each other. So, when people say, and I'm seeing so many people saying, don't look at real estate, zero real estate, sell your real estate, just live on rent. At least I don't agree with it at all. Navneet, I'll let you answer this question further.
I think it's each individual. Each individual is different. I think each individual will have their own life goals. They will have their own family situation, their own the return expectations, the risk appetite, the kind of volatility they can handle across cycles, and how you want to live and invest your money. I don't think one can give a generalized answer that and this is how you should allocate money across various asset classes, and whether one. I mean, I think having your own house is again a very very individual call. I would be in I think in that I think side of the fence that I think we need to have one's own house. It gives you a certain sense of stability. But I know investors, I think, who don't want to have it because they believe, and they have been proved right over the years, that equity markets have delivered better returns than what they could have earned on the real estate that they could have bought. Yeah, so they were better off by having money in SIP instead of paying the EMIs. But that's like each individual's is very different. Yeah.
Yeah, it's very different. And it's also your risk appetite.
For me, it would have been difficult to think that I would never have a house of my own and have only money in the equity only. Yeah.
And I
I think
personally made
it's
a
required
post
to be have both. Yeah.
I recently made a post on Elon Musk that how when he sold Skype shares, he got 180 million, and any other person, lot of persons in the world would have chosen to retire, live a good life then. And this guy takes 100 million, puts it in SpaceX, 70 million in Tesla, and 10 million in solar. And he didn't even have the money to pay the rent, and he took a loan against these shares to pay his rent. So, so you need to have a little bit of crazy, and that crazy has brought him great returns. But I don't think that's a journey for all of us. And it is also about luck.
Yeah, that we talked about earlier. And also, I think the leverage is a double-edged sword. I mean, of course, your returns get amplified. I mean, if it works in your favor, but on the other side, I mean, the survival becomes tough. So I think it's easier said than done. And I'm sure for every one example where I think they got, and it turned out to be a great, I would say, investment, even by leveraging. But there would be some other examples on the other side.
Yeah, they're definitely there. Also, Navneet, now taking last couple of questions. This is a very nice question, and I'm sure a lot of our investors out there will love it. It's a difficult question to answer, but also not that difficult. But it's about they're asking this question that look, if we were to choose an HDFC product for 10 years investment, what is the kind of benchmark returns that you guys are aiming for? Is it 10, 12, 15%? And which is the fund that we should pick up if you want to put in money in equity for 10 years from HDFC stable?
So as I said earlier, I mean, the difficult to pick up one because each individual is different, each family is different, and you have to look at your own life goals for which you are saving. your own. I mean, and then the ability to put that money, whether you are putting it lump sum or you are doing it over a period of time through the SIP. SIP is a great route to save. Of course, you have to remain disciplined. I think that question is better answered and then by someone in the Bajaj Capital, because they would look at your own individual situation and then suggest the right product. At our end, we have all kinds of products. I think depending on your need for income generation or for long-term wealth creation. And I mean, as I mentioned earlier, we have been a pioneer on the hybrid fund side, different kinds of asset allocation product, right from, let's say, a hybrid debt where you have up to 25% equity remaining in debt, to an equity savings where the equity allocation would be slightly larger, to a hybrid fund, balance advantage fund, the retirement fund, children fund for kids education or anything related to kids. So we have all the solutions and the products. I think it would be for each individual's specific unique situation that they would be in. And I think someone in Bajaj Capital can guide you better. And I think the role of that advice should not be undermined or should not be underestimated. It's very, very important to have somebody who understands you holistically. It's like, I mean, for a doctor once who understands you deeply, and then you suggest the right medicine.
So, guys, I'll say that, people don't try to save that 0.5% or 0.6%. It may cost you much more. And you see these things on app that you'll save so much over the next 25 years. Those are all hypothetical things which actually will never happen, because that's considering an X amount of growth. So, Navneet, just quickly,
Managing money is like all, as who said this, like Morgan Housel, I think that managing is all about how you behave. It's not about what you know, and some of these transactions. I think it's a long term. The biggest impact on the wealth creation comes from how you behave through cycles, through market ups and downs, through different phases of life, and that's where the important role which is played by a good advisor.
Yeah. So just one people are again asking this question, maybe do you have an internal benchmark for your funds for the next 10 years, like your flagship equity fund? Have you kept a benchmark?
So you cannot keep an absolute benchmark. Of course, there is an underlying benchmark for each fund. I mean, for a large cap fund, it would be, let's say, something like a BSE 100 or Nifty, or for a mid cap fund, it will be a mid cap index. For a small cap fund, it will be a small cap index. For and different funds, a hybrid fund will have a mix of equity as well as the fixed income index. So you don't chase a particular absolute numbers that we will deliver 10%, because each fund is different. There are funds investing in money market securities. Their idea is to deliver returns in line with where the money market yields are. And let's say a fund which is in a small cap equities, the idea is to deliver returns in line with what better than the small cap index. So you cannot have like one single number across the fund house that this is what we will deliver.
Very well answered. And also, we'll take just one final question. I know we are over time, but this is an interesting question. The people are asking, there have been a lot of NFOs by HDFC Mutual Fund recently. So, can you tell us a little bit about what's the philosophy there? Why have you done that, and what are the future NFOs? Which are the future areas you're looking at bringing new funds into?
So I've always been an admirer of SDFC Mutual Fund for not launching products because they are the fad of the season, or for not launching the product because that's the hottest product to sell, or that's what everybody is recommending, but selling the right product where there's a longevity of that product. We have the right investment capability. Our investment team strongly believes in that. We wouldn't like to launch a product for the sake of it, or for just gathering assets. The products that have been launched were to basically fill some of the gaps in the overall product bouquet. There are a lot of investors who are looking at international diversification. It definitely makes sense. And we identified a very, very good product. Our product team and investment team worked together to create this international developed world fund of fund. In one single fund, you get the diversification across all developed markets, multiple currencies, multiple sectors, right from US to Europe, European countries to Japan to Australia to Hong Kong to Singapore. I mean, you get in one single fund multiple markets, 1,500 plus stocks. In some of the passive categories, whether it was the Nifty Next 50 or the equal weight Nifty, some of the passive categories where funds have been launched. A fund of fund, which was launched in April, where basically in one single fund, a fund manager based on the asset allocation model is allocating money across equities and fixed income, and within the equities, let's say large cap versus mid or small cap, or maybe some of the thematic funds within that, and fund manager is doing for you. So some of these categories where the needs are there from set of partners or set of investors, but unless we strongly believe in our capability as well as the longevity and sustainability of that product, there would be a set of investors who would always need that kind of product. We won't launch an NFO for the sake of it. Next week, we have this multi-cap fund, which again, as I mentioned, I think somewhere in our conversation, it came up in one single fund. You get an opportunity where you are investing across market caps, minimum 25% in large cap, minimum 25 in mid cap, and minimum 25 in small cap. And in this fund, there is no style bias. And Gopal, who will be managing that fund, has got a long experience of managing funds, and that's why maybe just to fill that product category, we are doing that. But otherwise, we won't do NFO for the sake of it. Never. I mean, HDFC AMC has never done that. Yeah.
But Navneet, personally, large in these multi caps and flexi caps are my favorite, because I think that's where truly the active fund management comes into play and being. So they are quite exciting areas. So guys, thank you everyone for joining, and thank you Navneet for taking out time today. I hope we were able to add value to the lives of the people who are watching this program or who will watch this program in the future. We were not able to take all the questions. There is a QR code, guys, on the screen that you can see. Just scan that QR code. You can send in a question. We'll make sure all your questions are answered. And a lot of time people have some confidential question they don't want to ask in the public forum. So please go ahead, scan the QR code. You can ask your question confidentially also, and we'll make sure everybody gets their answer. And thank you, Navneet, for taking out time and being with us. Some last words from you?
Entirely my pleasure. And as we discussed earlier, I think the way to create wealth over a long period of time is to start early and invest regularly. I think the role of discipline is very, very important. I think internally we have been saying that, the wealth creation equal to STP. STP is sound investment plus time plus patience. I mean, that's the a good, I would say, a formula of wealth creation over a long period of time. And at HDFC MF, I think we are very, very, I would say, proud of the relationship that we have with partners like you and the investors who are there, and look forward to keep serving them.
Yeah. Thank you, everyone. Thanks. Bye, and looking forward to seeing you in our next FINtastic Talk. Thanks.
Thank you.
You perform.
Thank you so much.
You're an amazing human being and an amazing stock picker.